Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. The main immediate pattern here since September 2024 had been, and I suppose still is after a fashion, the breached and seemingly repaired dark blue September to December 2024 bear channel. That's currently at 1657 down to 1964, up to 1964. This pattern achieved its primary downside target mid-January and its secondary hard to reach target about a week after the primary target. Interestingly, the move down to the secondary target and back up again formed another new pattern, one which I'll discuss shortly. However, before that, I'd like to highlight another different, larger, longer-term pattern, and that is the bright red November 23 to September 24 bearish shift pitchfork. We are close to the bright red middle time below, currently at 1757. And 2 weeks ago, this helped hold up the market. I also have another pattern which I would like to discuss and maybe another to think about. That's the bright pink late September 2024 to mid-January 25 bearish Andrews pitchfork, which I drew 7 weeks ago to try and help make some sense of the recent moves. We are today a little way above the middle time below, which is currently at 1706. This pink middle time helped, along with the bright red middle time, hold up prices 2 weeks ago. All these three are indicative of the market pushing lower, but that we have also support below from about 1750 down to about 1650, though is a declining support. And once past the pink middle time, the support begins to dissipate. Additionally, there is an important support level at 1809 that has impacted this market every time we have seen prices come down to these levels. It is the interesting 21st century 50% Fibonacci, absolute Fibonacci line at 1809, which seemingly has capped the market today as well. Though the two working together have been a significant support, possibly now a resistance and an eroding force on any bearish incentive any moves lower. Now, I also went back 3 weeks ago to my monthly charts in a further attempt to get a handle on what technicals were operating there. The main pattern I saw there, which is still working, is the double top, an Adam and Eve type, that has been constructed throughout 2023. This had already reached its primary target 1880, but it has still left alive the harder to reach secondary target X down at 1630. This, as I've said for many weeks now, this longer term pattern is the one I choose to watch and see how it develops. However, it all depends if prices can break down through the pink middle time below and then exploit it further. Ice Europe white sugar in London. There continues to be three features to bear in mind here on this daily chart. The first is the obvious and broken, though now coming back to being repaired, purple late September 24 to mid-February 25 descending expanding wedge pattern. Currently 517.5 to off the bottom of my daily chart. This pattern has more than the requisite 5 touches and was severely testing the top side ever since late February, though enough that I would not classify it as a descending wedge pattern after February, though I'm still keeping an eye on the extensions to the trend lines, especially the upper trend line. The break upwards in mid-March reached up as far as the February 2017 high at 565 even, and in the process raised the question as to whether the action since February was a form of bullish half-raise rotation or a double top or something else. Today, I'd call it a double top, though there is a marked reluctance to fulfill its potential on the downside. If we exploit the idea of this double top pattern. Hence, a primary potential was down in the 492.8 area, which was achieved 2 weeks ago, whilst the secondary potential will be down at the 464 even area. This all very much depends on the true and significant break of the neckline area, something I thought we had seen 2 weeks ago and which has become increasingly murky since then. This is why I also said 2 weeks ago to, and I quote, also keep an eye on the bright pink late September 24 to mid-March 25 recently finessed bearish shift pitchfork. We're right now between the overhead upper tight, and that's currently at 558.5, and the middle time below currently at 520. This is a very shallow pitchfork, and the more the market moves lower through it, the more I'm beginning to like it. End of quote. Sugar white premium spread. 3 weeks ago we had a weekly key reversal up, though it was also a weekly indecisive doji cross, yet with the highest close since mid-July last year. 2 weeks ago an even more dramatic immediate countering key reversal down, closing below the declining gold long moving average, which is currently at 106.5. Then last week we had a counter to the counter combined bullish Arami and bullish closing white Maribosa. This, on some occasions, massive toing and froing up and down still finds today prices bracketed by the familiar 1 year gold moving average below, and on the top side by the significant twin combination of the 50% Fibonacci lines, the July 19 to September 22 move at 128 3/4, and the August 21 to September 22 move at 131 1/4, plus the June 2020 high just above at 134 1/4. Overall, we can start to see the action over recent weeks as a halt in the break up and out of what was originally a descending wedge pattern that developed into a big bear channel from April 24 to the end of January 25. We are now hesitating for 10 weeks, between the gold moving average, long moving average below, and the overhead 50% Fibonacci lines, the first of which is, as I say, at 128 3/4. I raised the question 3 weeks ago, and I quote, "Is this enough to start talking about a possible bullish halfway hesitation from the start of the year, or else a topping action?" At the moment, I still favour the idea of a possible bullish halfway hesitation, but I can now start to see the merits of a topping action. Hence, I'll retire after today from the original large descending wedge pattern seen throughout 2024. Targets on these. And that's the end of the quote. You see, there was and is a very large question mark hovering over all of this due to the overhead combination of the previously mentioned 50% Fibonacci lines plus the June 2020 high, and a congestion area we have overhead between 128 3/4 all the way up to 153 even, which has made the idea of a topside target originally pretty hard, then no longer viable. As for today, well, as I said last week and also now for 7 weeks, and I quote, "The market has not taken the bullish incentive by the horns." Sorry for the mixed metaphor there. "We have not pushed just that far enough as yet." End of quote. I also pointed out 7 weeks ago, and I quote, "Apart from this gold long moving average, we really don't have that much below until we start approaching the 85 even zone." End of quote. Nothing seems to have changed on this.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.